Happy Friday, November 14th, 2025. You are about to go on the markets. My name is Dano Weir with Sonoma Wealth Advisors, Fermata Advisors family of brands. And this week we are looking at the market. Wait, we do that every week. What happened this week in the market and why the AI build-out costs more than going to Mars? What am I talking about? We're talking about the insane price tag that OpenAI thinks that it needs and why the dude from The Big Short, who's made some news recently, isn't buying any of it and literally tapped out this week. You think the AI build-out is big? How much debt will be invented when everyone's got a portable 50-year mortgage? That happened this week. AI bubble stocks or not, we're going to take a little bit of a victory lap on staying invested through the April tariff crisis. We'll look at that across multiple asset classes. And finally, all that said, because we got to go out of both sides of our mouth, why right now Daren thinks, with the way that the market closed just today, that the risk is to the downside. Let's get into it.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, and Fermata Tax. On the markets starts now.
Let's get them in. Here they are, your managing principals for Sonoma Wealth Advisors, for Fermata Advisors family of brands, Daren Blonski, Chris Sipes. How are we doing this week, guys? Chris, how are you?
I'm doing very well, Dan. Thank you. It's another week down and another eventful week. You know, meme-wise, some weeks we get a little dry and there's not much to include. Sometimes we don't even include memes. This week was not one of those. There was just a fire hose of chaos coming at us, and I feel like there's just an embarrassment of riches in the meme world this week. So looking forward to diving in.
Yeah, Daren, there was a lot I felt like there was chess pieces moving on the board this week in a lot of different sectors.
I think that's a fair statement. A lot going on out there, I think. Well, I guess that's kind of a broken record thing to say, though, so let's not say that. I feel like there's always a lot of pieces, but I think the most important, if you're going to be one of the probably hundreds of people that listen and turn this off in about 2 seconds, the thing I would keep in mind is the front end of the risk curve, namely Bitcoin and some of these riskier tech stocks. They are not looking great, and so we tend to see those things go down before we do a dip, and we certainly seem to be in a correction, or maybe looking at a correction phase in the market, which wouldn't be shocking given how far we've run up.
We are going to get into the economy and a few of the developments there this week. But one of the storylines that I've been tracking, because I'm a movie guy, guys, so I come into this from kind of a media background. I did love the film, The Big Short, if you have seen that. That helped explain the mortgage crisis back in 2008. The real guy who is part of that story, Michael Burry, has had a flurry of activity in the last 2 weeks. We talked last week about how he announced a short on Palantir and Nvidia. Then this week, he straight up closed his hedge fund and indicated that he'll be announcing something on November 25th. So I'm dug in a little bit deeper to try to see what is his gripe with AI, and specifically, what is he seeing that he thinks is a bubble? Now, granted, guys, I don't have the CFP here, but I'm trying to understand layman's person's understanding of what he's saying. What he's basically saying is that all of these AI companies, OpenAI, Anthropic, they are saying that these massive chip investments that they're making, the chips are going to last for 5 to 6 years. But NVIDIA is saying they're only going to last about 1 year. So they're actually going to need a lot more chips than they're actually saying that they're going to need. And then in addition to that, that they're not only the chips that they're getting now are also being purchased on debt. And so he sees that as kind of a weak foundation for these companies. So I'm sitting there and I'm trying to figure out, like, what's a way that I can put this into context that maybe the average person can understand? What's a different category, different story that we can tell? So I thought back to this book I read, guys, called The Case for Mars, and I read this about 10 years ago. This book came out in 1996 by this author, Robert Zubrin. He's a space guy. Daren, you can see right there on the cover, Elon Musk even says it's, quote, worth reading. But he's a scientist who's basically arguing, here's why we need to go to Mars. And in this book, which came out in 1996, he basically says, hey, what you should do is you should build the rockets in orbit, because a lot of fuel is wasted just escaping Earth's gravity. So if you build it in orbit, you'd be able to have enough fuel to actually make it to Mars. Here's a blueprint for how exactly you would do that. So his price tag to do that in 1996 was $40 billion. Adjusted for inflation, that today is $80 billion. The AI, let's just round up to 100 because it's probably more than that. The purported build out that Sam Altman says he needs for OpenAI is 15 times what this particular author suggests it would cost to put a human on Mars. And so I think that was kind of my takeaway this week that Burry is trying to say, and other people are saying it too. The other people have been sounding the alarm too, that, yeah, is it physically possible to build out some of this compute power that they need? Yeah, maybe. But man, trillion? Like, whoa. Like, at a certain point, the price tag is just too insane. That was my take on it. What do you guys think of that?
I think it's complete wacko. What, like Sam Altman coming.
What, Dan's explanation or what's wacko?
All of it. No, just kidding. No, the whole AI run-up thing. But I get it, because you've got China that is all in on it, right? And if we're not all in it in the United States, then we're in trouble. And I think that's partially why Sam Altman even had an audience when he went to the government earlier this week and said, hey, we want you to backstop this, basically, which I guess enlists all kinds of questions about what role the U.S. government should have in any of these companies. But it does, man, it just feels like WWW all over again. I mean, I just can't help but feel like I remember a visceral feeling in college when the 2001 crisis happened, and like every other buddy had a WWW new tech internet startup going on, and that's the way this feels right now.
Chris?
Yeah, that's I think that there's starting to be the new narrative that I'm hearing in the financial world, because basically everything I listen to is financial based, and the narrative starting to switch from these guys are making so much money, they're creating this innovative product that we're all going to be using, to hold on a second, now we got to build these data centers. We don't have enough power, so they're going to have to build their own power sources as well. And so it's going from a very light capital, not a very capital intensive business with huge margins, to suddenly a very capital intensive business, which historically capital intensive businesses have not been very good businesses. So the narrative is starting to change, and they were financing all of this. I think importantly, they were financing it all out of cash previously. And now you're starting to see borrowing in that space as well. So that leverage is going to add an additional layer on there too. So who knows? I mean, these narratives can go for a long time, but it does feel like there's starting to be the whispers of, wait, how much money are we talking here? And you need to borrow how much, right? So, and if you think about it, in addition to that, the U.S. government's already got a massive debt load, and they are a huge borrower in the credit markets. So supply and demand is pushing up interest rates across the board. And so if you start to see even more borrowing in the AI space for this CapEx, that could keep pressure on interest rates, out into the future.
I think there's another important story around Burry, right? And I think it's a perfect example. Going back to the previous slide and Michael Burry hanging up the hat. And what a great reminder to us all that bubbles can stay alive much longer than you can stay solvent. So, even though we're saying here in this conversation that like this just smells like a bubble, it looks like a bubble, it talks like a bubble, it walks like a bubble, but that still doesn't mean bet against it, because as you can see, I think Michael Burry's. I'd have to go back to the research on this, but it feels on a regular occasion has come back onto X or Twitter, whatever you call it, and said, "Hey, I'm going to short this thing," and then never mind, and goes away. So
yeah.
It's
That's
just
a
a
great
reminder
point.
to all investors that like it doesn't matter who you are.
Yeah,
Never
Yeah,
bet against
yeah.
the bubble.
That's a great point. You're not Michael Burry. You're not Warren Buffett. And, they're on a different time frame. We talked last week about all the calls that he had made that were not correct. We have this weird thing as humans where when somebody gets something right and they hit an amazing shot like he did with the Big Short, that we just go ahead and assume like everything else that they're going to say and do in the future is going to be correct too. And we know that most traders are barely right more than half of the time in their bets. And it's just being right more often than they're wrong, and when they're right, making more money than when they're wrong. And so that's one. And two, they're on a different time frame than most, retirees or people that are investing for the long term. This is a different trading style, a different approach than most people should have with their portfolios.
Agree, and just we've talked about him a couple times the past couple episodes, and I think it might be the last time we talk about him, because we don't, as a firm, we don't look to a lot of Nostradamus types, and I don't think as an investor you should either. It's important to take it in as a data point, but ultimately you're making the decisions for yourself.
Let me make one other point to this, because I think it's important. And when it comes to these people who pontificate about here's what's going to happen in the market, here's how I imagine it. We're playing a game of musical chairs, and there's constantly all these people in the musical chair wandering around saying, oh, the market's going to end, the recession's coming, the bubble's happening. And imagine each one of these people playing in the game of musical chairs has an opinion about the market. They share their opinion. But eventually the chair gets pulled out from each and every one of them until there's one left standing. And I think that's more or less what happens when we hear these financial pontificators talk and say, oh, this is for sure going to happen. This is happening, blah, 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 blah. It's like the game of musical chairs. They all get taken out one at a time, and there's one left standing when it actually does happen. And then we all look to that one individual and say, oh, they're so smart. They know what they're talking about. And Michael Burry is a perfect example of that, in my opinion, where he called this crash. And so then everyone thinks, oh, forevermore, he's smarter than everyone else and he can call a crash. And it's just a matter of time before he's wrong. And he just got lucky once, and the music just happened to stop. Because if you think about it, any given time, there's hundreds of people calling for the demise of the market, demise of the world, demise of this. And when that actually happens, we all just look and say, oh, that guy called it and he's still standing, so he must have been really smart. But in reality, there were thousands of other people behind those pontificators that were wrong.
You guys want to know something really funny? Is we use a platform called StreamYard to do our show. And as I log into StreamYard today to do the show with this kind of Mars theme that I had, this example I had, there's literally an animation that has never popped up, and it's a rocket ship, and it goes, StreamYard has made it to Mars. And it's some multi-aspect ratio streaming thing that they have. So it's like, wow, like maybe dead on with the Mars analogy this time. Kind of funny. So should we be doing a massive $1.4 trillion build out for a country that can barely keep its federal government open, Chris? That's the question.
Yeah, I figured we start off the show with a little good news. We finally ended the government shutdown. It's the longest one in history. Congratulations, guys. Another first time, unprecedented situation to manage through. Here's another one that we just went through that has not happened before. And you can see that this one exceeded all the others dramatically, except for the one that we saw, the other one that we saw recently in 2018. Not that much further from there. So, and the government wants to make up with us, guys. So they are talking about doing another stimulus to make up for the fact that we had everything shut down. President Trump announced on Truth Social, I think it was on Saturday or Sunday last week, like a tariff dividend or something, the $2,000 for non-high income earners that they would be getting supposedly from tariff revenue. Of course, all the fact checkers said, yeah, but we're still gonna have to borrow to do that if it goes out. But it's just funny, I took it as they're trying to make up to us for having everything shut down for so long.
For months or probably years at this point, guys, I've been saying on this show, the government can't stop printing. Don't worry if your party wins or not. They're still all going to print. And we saw that with the Doge and Elon Musk trying to cut out stuff. Like, the government didn't have a choice but to print. But look no further than the government saying, hey, we shut down for a month. And so we're going to give you all stimulus check just to make the debt go up even more, right? We're not talking about taking this tariff money and putting it back into the national debt and paying down our debt. No, we're just going to give it and hand it out more. And it just goes to show, like, the way our political system is built, like, they cannot get off the train. The train is on runaway. And that's just a reality. And will it be 70 trillion, 80 trillion, 100 trillion before we have to do a debt jubilee to get off this path and change things? I don't know, but they can't stop. And I think another perfect example of that.
Yeah.
Chris is bringing the meme game this week. Chris found a few.
Well, shout out to Russell, Russell Van Sistine, one of our advisors. He found this one and nailed it. The other announcement was from Bill Pulte, the housing director, saying, hey, what about a 50-year mortgage instead of a 30-year? Well, let's extend it out for 50 years to, essentially help the people in the housing market that are struggling. I guess it's trying to do the same concept of, like, well, if you can't afford the $100,000 car, in 3 years or 5 years, let's kick it up to like an 84-month payments, and maybe you can make the payments then. Who knows? But this meme was pretty funny. My first bike, my first car, my first job, and then my first house, and shows somebody with a walker going up to the house. I laughed. I don't know about you guys, but I thought it was pretty funny.
I did, and I did some digging. Well, we have another slide later, but I did some digging on this. Not only are they talking about extending the term to 50 years, they're also, Secretary Pulte also talked about making them portable and assumable, meaning you could take your 50-year mortgage, and if you wanted to buy a new house, you just take it to your new property, I guess, or it's assumable so that if you were to go somewhere else, whoever buys your house next can just assume the mortgage that you already had.
Well, so, I think, yes, and I think what they're talking about there, Dan, is taking the current mortgages. So if you're one of these people that's got a 2.5 or 2.2% mortgage and you're like, I'm never leaving this house because I have this amazing mortgage, I think they're talking about making those assumable and or portable. Which that would be interesting. I don't know how they do that, but that's another interesting twist.
Sounds like a political bacon move to me.
Yeah, more pork.
It sent all of the, because I follow all kinds of finance people now, and some of them are like the real estate double backflip guys who are borrow, lend, whatever. I've got my Airbnbs. Oh, as soon as you said portable and assumable, they're just like, well, based on the time value horizon of money, now they've got, 6 different moves they can do. And it was just like probably sending poor Dave Ramsey into the morgue.
Yeah, this one literally, I did laugh out loud when I saw this. From the Babylon Bee, it says it was a sudden shock he wasn't able to handle. Dave Ramsey in critical condition after learning of the 50-year mortgage. So for those that don't know, Dave Ramsey has had a financial show on the radio for many years, and he is anti-debt, which we think is a good thing. He also is an advocate for fixed mortgages, and preferably, if you can, do a 15-year mortgage. Now, he's from Tennessee, and an area of the country where that's a little easier to do than, say, in California. But he's an advocate for going the opposite direction of the 50-year mortgage, which is,
Right.
I guess, why this financial humor cracked me up. But for the average person, might have saw that and just said, "What's so funny about that?" I don't know.
Who?
I think half the things that we find funny, the average person looks at us with a strange face. Don't worry.
I think half is generous, Daren. I think half is generous. But
I agree.
it's comforting to have you guys on teams that I can send these things to, and I know you appreciate it. So, so the savings on a 50-year mortgage, like how much does it actually matter? Does it actually lower your payment very much? It turns out not really. This is from Mike Simonson, and he's showing a chart from Compass, and they show various interest rates, the 30-year fixed versus a 50-year fixed at these different interest rates. Now you'll notice the 30-year is at 6.3, and then they have a couple of hypotheticals on the 50-year at 6.8, 7, and 7.25. The reason there is, hypothetically, if you're going to borrow for 50 years, that interest rate is likely to be higher than the current 30-year. Okay, and that makes sense because you're borrowing the money for a longer period of time. It's a higher risk to whomever is lending you that money. So just like now, if you go to get a 15-year mortgage, chances are you're going to get a lower interest rate than a 30-year, and that's been more dramatic in years where the interest rate curve is more normalized. Recently, that curve is basically flat, so there hasn't been a ton of difference between a 15-year and a 30-year. Because interest rates, we had the inversion on the yield curve for many years. But you can see really by the time you factor in the little bit higher interest rate and such, it's not a huge difference in that savings. So I'm also not a fan of. I think one of the big reasons why the housing market is having so much trouble right now is because of all the government intervention in that market. Government is more involved there probably than almost any other market, maybe other than farming. And the more that the government gets involved, the higher the prices end up being. And I think you see that in student loans. And you've definitely seen it in housing, whether you're talking about the regulations or the lending side. And when I say regulations, I mean where they can build homes. And so if anything, this is probably going to maybe spur more demand, which our problem really is supply in the housing market. We don't have enough houses. And so I'm not sure spurring demand is the smart move here. I definitely don't love extending out the time period even longer.
I think that's also tied, though, to the portable loan idea, right? Because I think part of the reason we don't have a lot of mobility in the housing market right now is the interest rates are so low in so many of the buyers. And that's ultimately stopping a lot of people from moving around.
Yeah,
absolutely. True. Daren, did you have anything you wanted to say about the 50-year mortgage? Because you were kind of going off on Teams messages this week.
I think Chris wrapped it up pretty good. It's optics. It's a joke. Don't take the bait. That's my outlook on it.
Yeah.
I mean, it might save you $100, in your monthly payment, but for that $100 per month you save, you'll end up with, another $500,000 in debt over the life of the mortgage.
Yep. Remember, a house is not necessarily an investment, right? There's a huge consumption piece of it. So be careful out there. Now, the median age of U.S. home buyers is at an all-time high. We talked last week about first-time home buyers and all of that, but this is showing the median age of U.S. home buyers in general is reached almost 60 years old. I mean, that's as you can see on this long-term chart. This goes back to the 80s, where back in 81 the median age was around 30. So median's in the middle, right? And so you had people younger than 30 buying homes. Now, my dad would be quick to remind me, back in the early 80s, I borrowed money at 18% to build a building, and the interest rates were crazy high back then. And so for people saying like interest rates have to be lower in order for the housing market to heal, I don't necessarily think that that's the route, given that here, in the early 80s, interest rates were way higher, double digits, right? And people were able to buy homes back then at much younger ages. So anyway, if you are young, where's a good place to look? Well, these are some markets that the areas where younger people can still afford a home. So this is the percentage of adults under 30 with a mortgage in America's 50 largest metro areas. I was very surprised to see Nashville at the top of this list, given that it's a pretty, hip and popular place. Indianapolis, Pittsburgh, Cincinnati, they always seem to be on the list, but Nashville is one where I feel like it's kind of a buzz city. So I was surprised to see Nashville at the top. But and you see all the way at the bottom, San Jose, less than a fraction. There's a fraction of 1% of people under 30 that can afford a home there, and so. You probably want to avoid most of those areas, which a lot of those are in California, unfortunately. Interesting nonetheless. Now let's get to the vibes. If I had to, I feel like we talk about it every week, but this week especially, there's been a lot of talk about the vibes in the market. Bearishness jumped up to 49.1%, so a huge jump in bearishness, although you can see we're still way off the high of bearishness in early April when we were at almost 62%. So big jump up in bearishness this week. The CNN Fear and Greed Index got down to 22 extreme fear, which is down from 24 extreme fear last week. And then Bitcoin hitting 16. I'm trying to remember, guys, the last time we were in the teens on the Bitcoin Fear and Greed Index. That's down from 24 fear last week. Now, all three of these indicators are kind of lining up with one another. They're all showing a lot of fear. I know we've talked about it many, many times, but a lot of times when you get in that extreme fear zone, hey, that start as a contrarian perks up, like, hey, maybe people are getting too pessimistic. Warren Buffett always talks about the market being a manic depressive. It gets way, way too excited and happy, and it gets way, way too depressed. And there's swings between the two occasionally. And so, who knows, maybe we're heading towards one of those overly depressed sentiments. And I think if I had to guess where that's coming from this week, it is the chatter from a lot of the Fed governors this week. We did not get the CPI update because apparently somehow that information was destroyed and gone forever. So there's no CPI report. However, there's a lot of signs that inflation is being stickier than what the Fed likes to see, and the Fed governors have been out, talking about it. And so now we've got a 50-50 chance of that 25 basis point cut in December that, if you guys remember, just a few weeks ago was almost a lock in terms of the expectations of the market. Double check the betting markets, also about a 50-50 chance in the betting markets. So the futures market and the betting market is lining up here. And so a little bit of pessimism when it comes to the rate cutting expectations for the rest of the year. So maybe no rate cuts for Christmas this year, guys.
What? I was promised 50.
Well, if you take a look at the short-term Treasury rate, the 2-year Treasury, that's what we kind of look at as the market, the quote-unquote market's pricing of short-term interest rates. Versus the Fed funds, which is the gray line here. We've got the Treasury rate at 3.56 as of yesterday, and then 4% on the Fed funds. So not much of a spread there, 44 basis points. And so you're getting tighter. It's not like the Fed is way off. Occasionally it gets spreads of 75 basis points to 1%. And then people really start crying for that cut from the Fed. I think you could still argue that a cut is warranted, based on these numbers. But we're not way off. We're not completely out of the ballpark when it comes to the market's expectation of these rates. Sentiment, though, we've got an update from the University of Michigan Consumer Sentiment Index, and this is from Charlie Biello. He says, the University of Michigan Consumer Sentiment Index has moved down to 50.3, the second lowest reading in the survey's history, which goes back to 1952. But at the same time, U.S. retail sales grew 4.8% over the last year, outpacing inflation by 1.8%. We've never seen a disconnect this wide between what the consumer is saying and what they're doing. I think that is, something to consider. I would love to know, and maybe Charlie knows this. I was gonna ask him on X to if he knew this, but how many times has the consumer sentiment been this low, and the market has been at all-time highs? The stock market at or near all-time highs. Because you look at these other times where we've been this low on the sentiment indicator, on those gray bars, we've been in recession, and we've been towards the end of a recession. So, and, if you look at, say, June of 22, markets were down dramatically at that point. Obviously, 2008, 2009, the markets had been destroyed. 2000, the markets were down a lot. So when previously has sentiment been this low with the markets being this high? I don't know the answer to that, but I would love to know. And go ahead, Dan. Did you have something?
Sure, I did. I think that last chart and what you're talking about is that K-shaped economy that we keep talking about, which is that a few people going up the escalator and a bunch of people going down the escalator. I saw a clip from Breathe. Don't let these names trigger you. But Scott Bessent, who's the Treasury Secretary, he was on Tucker Carlson this week, and he quoted a stat that said...
on Tucker Carlson, like, wow, that triggered.
Yeah. Some people just crashed out, but just try to breathe. I even shared it on my Instagram because I thought it was meaningful. He quoted a stat that said, summer 2024, Chris, more Americans took European vacations than ever. Summer 2024, more Americans went to food banks than ever. So it's that separation between, the consumer sentiment is, in the doldrums because you have a large percentage of the population who's struggling. And then you've got the escalator that's going up, and they're buying like crazy because they're doing great. So I think this is that separation, that K-shaped economy we've been talking about.
Yeah, I think that's probably the case. And with markets kind of driving the upside of that K-shaped economy, right? So it's been a virtuous cycle where the markets do better. That top, 10% that owns most of the assets are using those assets to spend and do things, renovate homes, et cetera, et cetera. And how long does this flywheel keep turning? Because when you look at valuations, kind of no matter what metric you looked at, and I like this one because it shows a combination of trailing price to earnings, forward price to earnings, the cyclically adjusted price to earnings, price to book, price to sales, enterprise value to EBITDA, the Q ratio, market cap to GDP, blah, blah, blah. Like basically whatever you want to look at. Where are we? Well, at or above the most expensive in history. So like I said, people's sentiment very low, markets very high. There's a huge disconnect, and I just don't know that there has been a time where it's been disconnected. Now, what's driving some of that sentiment? I would love to know this over the longer term as well, but there was a Harris poll for Bloomberg this week that showed a little over half, 55% of Americans are concerned about losing their job right now. That seems like a very high percentage to me, guys. 1 in 2 people are concerned about losing their job. Now, is that economic conditions? Is that AI? Is that all of the above? That seems like a very high percentage of people concerned about the future of their position. So that might be driving some of that sentiment. Then we've got the leading economic indicators. So we've talked about this many times where it's like, hey, a lot of these indicators just don't work anymore. Now, this is from Yardeni Research. He puts out some of the best research out there, and with some commentary from, I'm blanking on his name now. Give me a second. It'll come to me. Toby Carlisle. So Toby says, this 60-year economic indicator just hit a level that's only happened before recessions. This chart displays the ratio of leading economic indicators to coincident indicators. Let me show you. That's this one here. And if we could take down the little tab so you can see the punchline of this here on the markets logo. I'll keep reading. Well, there we go. So see that dislocation there? That's what he's talking about. Okay. This chart displays the ratio of leading economic indicators to coincident economic indicators from 1960 to the present, with gray bars marking the U.S. recession periods. Leading indicators are economic metrics that tend to change before the overall economy shifts. Stock prices, building permits, consumer expectations, yield curve, all of these things go into these LEIs. Coincident indicators move with the current state of the economy. These would be things like employment, industrial production, personal income, manufacturing sales. When this ratio declines, the relationship to each other, it suggests that forward-looking indicators are weakening relative to current economic conditions. Essentially, the economy's leading edge is deteriorating while current conditions haven't yet fully reflected that weakness. So if I go back to this other chart where you kind of look at the ratios, and that's what he's talking about, when that ratio kind of reaches this extreme and you see those shaded areas, usually when we get that downward slide and shift, we're in a recession. We're actually towards the end of a recession in most of these cases. And so we've talked about this theory before that, hey, maybe we've already been in a recession. They just never really called it one. And it was covered up by the fact that housing prices stayed high, stock market prices stay high, because we had kind of totally abnormal, whacked out conditions in both of those markets. What could have driven that? Well, unbelievably huge government deficits. So this is what they bring in versus what they spend yearly. We can see that those deficits really blew out going into even coming into COVID. They were starting to widen, but they just really blew out during COVID, and we've kind of stayed at this level at this point where even with the markets at highs, with the economy doing great, the tax revenues are just not covering what the government's spending. So there's a stimulus there, right? There's a borrowing and a stimulus. And then we've got the money supply, M2 money supply, and this is on a log scale. So it doesn't look quite as dramatic if it wasn't on a log scale, but it's still significant. This is going back 10 years. We've got an 80% increase in the M2 money supply in the last 10 years. That's a lot. And then when you look at government debt, this shows the increase in government debt over the last 10 years has been significant as well. So we've kind of been borrowing and spending and going about our merry way to the point where that's covered up a lot of sins. The government is reacted in the way that you would expect them to, like in a recession, essentially. Like the Keynesian economists say, hey, when everybody else pulls back on spending, then the government steps in and smooths out that business cycle, right? However, lately the government hasn't been stepping back when the economy's recovered. They've just kept the foot on the gas in terms of the stimulus. So, ending on something positive, though, where does that leave people? Well, as we always preach, diversification. Don't try to guess what's going to happen. Remember, back just as recently as April, we all thought the world was ending, and now we have the benefit of hindsight, and we know that staying the course worked again. Thankfully, we didn't have to wait that long. We got instant gratification in this case. But this shows year-to-date returns across different equity categories versus where they were in April. Now, U.S. small and medium-sized companies have really they've been in the doldrums for years. They have not benefited. They were down a lot in April. They haven't bounced back as much. But on the flip side of that, how many people would have thought, with all the tariffs, with all the changes in trade policy, etc., that you would see the highest returns from emerging markets, from developed markets, right? And
Dan, put that like clap on or something for him. That noise.
Oh yeah, where is that? I gotta have that better. Here we go, Chris. This is our victory lap for international.
Thank you. Well, I count myself in this boat. Look, I didn't think in the spring that the emerging markets and developed markets had the best chance, coming out of a trade war, coming out of a tariff war. And to be honest with you, I didn't really think U.S. stocks were going to do that well, and based on that, right? But it shows you have to have a lot of humility when it comes to investing, because you just don't know. You don't know what's going to happen. You don't know when it's going to happen. So you have to invest in a way that you understand that. You understand your limitations, and you diversify because of that.
Mr. Blonski, you want to show us from a chart perspective how this week played out, and why you said to me at the start of the episode that the risk you think is to the downside?
I do. Let's start with the S&P 500. So the S&P 500, for those who don't know, is the largest U.S.-based stocks out there. So we use it as kind of a proxy for the quote-unquote market, when in reality, the market is much larger than the largest 500 US-based stocks. But anyway, nonetheless, that's kind of what the news reports. That's what people kind of think about. And when we look at this chart, so this is looking at the daily chart. So this is how the market moved on each respective day. So in this case of this week, we had two updates. We hit this downward resistance trend line, and that became resistance. We got rejected and came back down in. Looks like we're finding support in the zone of, let's call it 660-ish and change in that area. And so you can see we're in whenever you have a chart that is making lower highs, then you start to say, okay, are we on a downward change of trend? However, I will say that on the bottom here, you can see how we're making higher lows. So what you have is this consolidation coming in here. And typically when we see markets consolidate like this, then you tend to get a pretty decent move one way or the other. Too hard to say which way it's going. But that's where we start and say, okay, well, can we find any other clues looking through other charts? So when we look at other charts, let's take a look at volatility. So VIX is a measurement of how those who trade the S&P 500 futures feel, how complacent they are. The fact that we've had a little bit of a spike up in recent days tells you that there's a little expected volatility in there. It's not a particularly good predictor, but what you can see here is we're making lower highs in a VIX. And when the VIX goes up, volatility goes up. Usually that means a down market. So as this indicator goes up, market goes down. It's not perfect. It tends to be imperfect in many ways, but just kind of if we're going to add the holistic approach to all the markets and try and get some clues on where things might be headed, that might be something we look at. We definitely got to look at the mags. So this is an ETF that tracks the Magnificent Seven, which have been responsible for driving most of this market. And when you look at this from a visual heat map standpoint, you can see that the stocks here in Microsoft, Nvidia, Apple, Amazon, Google, Meta, Tesla, those are the big stocks that take up a huge portion of the S&P. I mean, Nvidia is, I say this every week, I feel like, is exponentially larger than just the financial sector alone, let alone energy. It's like 3 times almost. It looks like the energy. We're talking oil here, folks. A very significant part of the world economy. Nvidia is substantially bigger. And this is the risk that Chris and I allude to each week, where we say, look, it's looking a little funky here. When you've got this kind of bubble mentality happening, the first thing you could see is that we are in a downtrend in the Mag 7. So if the Mag 7, which are a large part of the market, are going down, it's going to take the whole rest of the market.
I think that's on your second screen. There you go. Yeah.
There you go. It's going to take the whole rest of the market to pick these Mag 7s up. Good news, bad news of the Mag 7s this week. You can see this actually just moved this to the weekly. You can see that we've had 2 red candles in a row now, but we didn't fall below this area, and we've briefly visited below that $64 this week, which would have been a lot more. I would have looked at that as much more negative. So I'd say the downtrend is in, but it's finding some underlying support at the moment. I think there's some particularly interesting patterns forming in the silver and gold markets. I'm going to put on the 4-hour chart because I think it's really clear. But we have a chart pattern. Actually, let's do daily. We have a chart pattern called a double top, right? So when the market trades up, it trades up to a certain level. And then this right side of the top is lower than this top. And that double top can be a topping pattern. What we're going to want to watch is silver gets down or close to this area, which is considered the neckline over the next couple of weeks, into $47 an ounce. That could be really bad news for those who like silver. So everybody piling into silver right now should feel very questionable whether or not they're going to have to hold that silver for a very long time to get their money back. As you can see, last time we were up this high was 2011. So imagine everyone all the way here and had to wait all the way to here to get their money back. And again, that's the risk of chasing momentum price up. You don't know when it's coming back down. And the theory is like, it's just going to keep going forever until it doesn't. And then that's what creates that bubble mentality and it bursts. So silver looking a little questionable, as is gold. And you can see the double top, and is even more pronounced with a downward trend in place. It looks like got to watch $39.30 an ounce. If we break through $39.30 an ounce in gold, could be a rough go for a while. Now, some think, well, hey, the economy might be getting worse. Maybe gold is going to help us to, gold could be one of those assets that does really well if the economy goes down. Maybe, but it's so overbought right now. It feels like that I kind of question that thesis. Then let's look at oil. So we got gold, silver looking soft. We've got the stock market looking soft, but finding some support. And then let's take a look at oil next, because oil, everything we have, you're sitting in your house listening to this, the phone you're hearing this on, I mean, just full of oil products. This is some interesting podcasts and such I was listening to this week that, I don't know if you guys caught this, but Ukraine has actually been, throughout the whole war with Russia and Ukraine, next to no ghost oil ships have been hit, because they say that the U.S. has been pretty clear. You need to let the oil keep flowing, because if you create all these recessions, then that's and depressions, whatnot, through an election, that's problematic. So Ukraine's been in this kind of difficult spot of trying to fight this war for their existence, but also not doing too much damage to Russia, because if you do, then that impacts the rest of the world economy, and then all the neighbors will be not happy. It's kind of this slow burn approach. Well, when it comes to, because it seems that oil's low right now and we have a glut of oil supply out there, that they're allowed to start hitting some of these boats and attacking some of this oil infrastructure, which is kind of interesting, and it's not impacting oil at all. I think part of that is because the relative calm and peace that we see in the Middle East, that oil's flowing in the Middle East. And so that's giving cover for the Russian oil to be somewhat attacked. Also, interestingly enough, that Secretary Hegseth announced this week that we're going to be participating in something to the tune of the Southern Spear is the title they gave this one. But we're going to be going after the narco drug traffickers. Like it, hate it. I don't know. It sounds like we're getting ourselves into another ugly war in the middle of a jungle somewhere. But nonetheless, we're going to start going after some of these narco terrorists down south of the border from us. But when you look at Venezuela is sitting on massive oil supply. So this glut in oil, which is interesting, could be allowing the cover to deal with some of these other geopolitical issues that are happening out there at the moment. I think the timing is interesting. Nonetheless, whether or not it's completely connected, I don't know if that's a stretch, but certainly interesting timing when it comes to why they're politically doing what they're doing. So when we look at the front end of the tip of the spear, speaking of spears with risk, you have got Bitcoin, right? And so Bitcoin looking pretty shaky. I guess Michael Saylor's been getting a lot of heat lately because he's pretty leveraged on the Bitcoin trade. And so you can see we revisited here this 95,000. We haven't been in this area since, let's call it May of this year. We're back down. I'm not particularly bearish yet. I'll be really interested to see how things go, though, when we hit, close today. But definitely some pull down, pull back in the Bitcoin, which then you feed that into the stock market. And the lower highs we're making the stock market, increased volatility in the VIX, mags going down, gold looking questionable, silver looking questionable. There's this general financial asset kind of pullback. It looks like it could be fomenting. Then there's look at bond market to say, okay, well, bonds are supposed to be negatively correlated to stocks, right? Well, wrong. They used to be at one point in history, I guess, but not anymore. Typically, when we see stock market sell off, we see ag sell off too, which is the bond index. And that's not looking particularly weak, but questionable. It's starting to trade in a sideways kind of slot. Could argue maybe the beginnings of a triple top there. So you can see the head, a shoulder, the head, and another shoulder right there with a neckline moving up there. So could be some weakness for the bond market right now. Maybe we see that going down. That would feed into certainly Chris's comments about inflation and inflation going up more than we thought. So let's take a look at the 10-year, because that would be telegraphing some of that. The fact that the 10-year has not continued to stay high, or the fact that it stayed above this upwardly trend line and hasn't fallen through that trend line makes me think that, yeah, maybe there's some stickiness in inflation, that bonds have an opposite effect. So if interest rates are going up, then bond rates are going down. And so if the market's saying, hey, interest rates might be going back up, then we'd start to see bonds come back down. So anyway, something to watch. I don't think there's enough on that screen yet to be too excited about nothing. One other of the big darlings of this bubble boom we are in right now is Palantir Technologies, which is a government AI play. It's done exponentially well. Lots of connections to the current administration. I mean, just look at this run this year in 25. Just crushing it this year. So that's a stock I kind of watch to see maybe when the bubble comes out, because this seems to be a favorite. The fact that it's hanging in there on support around 170 at the moment, did trade below, but then closed up higher today. I think it's hanging on a lifeline there. So generally, I'd say the risk of the downside right now. I think do I think we have like some major recession head or what? I don't know. Do I think that, everyone needs to button down the latches and protect themselves? I don't think see that at the moment. I just think, we've gone pretty hard, up pretty fast. Correction would be normal. And then maybe we ride out a few more soft weeks in November and ramp into the end of the year. That would be the general sense. Things tend to ramp into the end of the year. Although the last time Trump had his first year in office, we did not ramp into the end of the year. So maybe we're following that Trump trend again. Anyway, let's leave it there. I hope everyone has a wonderful weekend. And AI build costs more than going to Mars.
Awesome. Chris, did that analogy hit home, or was I too far out into the orbit on that one?
I see what you did there, Dan. Bringing it full circle. No, it's very difficult for us to get our head around these numbers. They're so huge. Whether you're talking about government debt, the size of the economy, how much money's going into AI, who owes whom what. It's difficult to understand. So you gotta create analogies to help us, right? So
yeah, and I think the undercurrent of what we discussed with all of this, with the market, with the economy, is that there is this AI thing, and it's not a question of can it be done. It can be done. A lot, which they've shown in bursts already that it can do some phenomenal things. It's will we do it? Is we literally could be on Mars right now, have a human on Mars, but there's no will, political or financial otherwise, to have gotten it done since the moon landing. So I think it's a similar situation with AI right now, and we shall all see and experience in real time whether the AI bet is real or not. Thank you so much for checking out the show this week. We really appreciate it, especially if you made it this far. Gosh, 13 viewers to the end of the episode. We appreciate that. See, Daren, we got 56 minutes in. We got 13 people watching. You said 2 seconds, so we're coming along in the world. If you're new to the show, my mom, yeah, and Chris, yeah. The other 11. The other 11 are Chris's kids. The show, you can help the show by subscribing wherever you are. Following us, you won't miss future episodes. So whether it's Spotify or Apple Podcasts or YouTube, if you subscribe, you will not miss future episodes. And you can learn more about us at sonomawealth.com. We thank you for checking out the show, and we will see you next week.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Alloway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.